The period since the global financial crisis has been an anomalous one in markets. We've seen ever-increasing levels of concentration, and in the past year, the Magnificent Seven stocks have driven markets to even greater levels of concentration as AI mania has taken hold. Joining me today is Fund Manager Mikhail Motala, who will be talking about what this means for investors. Mikhail, so I think to kick us off, maybe you can explain to us how we got here.
Sure, Audrey, that's a great place to start. So if we look at, and for this we'll dive into interest rates. If we look at the global financial crisis that you mentioned, the response to the global financial crisis by central banks around the world was to cut interest rates to artificially low levels. And that started in the end of 2008 and lasted all the way until the latter part of the next decade. We then saw a brief rise in interest rates until they were cut to zero again, post the advent of COVID-19 in 2020. And that lasted all the way through till the end of 2021. So put another way, for the bulk of 13 years, we've had interest rates in the developed world at close to zero. So what that has resulted in is that as interest rates have fallen, the value of what we call long duration assets has increased. Long duration assets typically mean assets where the bulk of the value lies in the outer years, so they get discounted back at lower rates. And those values have been boosted by virtue of interest rates falling. Now, an important distinction to mention is that low duration assets or long duration assets can emanate from any sector. This period has just happened to coincide with numerous booms in technology. So we've had the adoption of mobile internet use, we've had the advent of social media, and more recently we've had AI. So the long duration assets of the day have been technology stocks. Those Mag 7 that you highlighted are the large cap technology stocks that have delivered the outperformance and concentration that we see in markets today.
So what does this mean for investors, and what should they bear in mind when it comes to constructing their portfolios?
So many investors have substantial exposure to these stocks. And the reason is because they've become so hard to ignore in market indices. Now, whilst they've been immense and good performers looking back, to hold those assets today implies that the future has to look the same as the past. And there are a number of reasons why we'd argue that the future may look very different to the past. At the heart of the argument is the resurgence of inflation. We saw the first bit of that out of the COVID-19, or as the COVID-19 pandemic dissipated. And then that was accelerated post the Russian invasion of Ukraine. We are at an interesting juncture currently where market consensus is that inflation has peaked and interest rates are starting to fall. But history tells us that there are often multiple waves of inflation. And if we look at the fundamentals that lead to inflation, they are posed to create inflation to be more persistent than what the market may assume. So from where we sit today, investors may have too much exposure to assets that have done well in the past and too little exposure to assets that will do well in the future.
So the past few years has been a difficult period for stock pickers, but PSG Asset Management believes this is about to change. Can you provide us with an idea why and talk us through the PSG Asset Management philosophy?
Sure. So the period has been difficult for active stock pickers to outperform because the performance of the market or the index has been so great, as the index has become dominated by these large cap technology shares. So outperforming whilst being underweight those stocks has been incredibly difficult. If we have reached an inflection point and fortunes are about to reverse, then automatically active stock picking becomes a lot easier. However, even within active stock picking, we believe at PSG we are well placed to navigate this environment because of our philosophy and our 3M process. And I'll call out two examples as to why. Number one, we focus on the inherent quality that the market may be missing or mispricing. And that often leads us to uncrowded and unloved areas of the market where we find opportunities. Number two, we have an active focus on the supply side of the supply-demand equation. We know that when there's a supply-demand imbalance and demand outweighs supply, it bodes well for future returns from assets. Now, that imbalance can arise not only because demand grows, but also because supply falls. And there are a number of reasons or a number of areas where we find that supply falling is boding well for good investment opportunities.
So, Mikhail, can you give us a few practical examples of where you are finding opportunities in your portfolios?
Sure. So that supply-demand imbalance is most acute currently in the real economy. And to illustrate, I'll first talk about South Africa and then we'll move abroad. If we focus on South Africa, two areas of the real economy where that is acute is the metals and materials space. And if we hone in on two examples, we'll call out Glencore and Afrimat as two companies which we currently own in our portfolios. Both of these companies have a high-class diversified asset base. They are run by good management teams who allocate capital in a shareholder-friendly manner. And the sweetener is that they are offering great bargains in terms of the valuation metrics that they are currently trading at. If we move abroad, two sectors I'd call out are the energy sector and the shipping sector, both of which has served us well in our portfolios. Energy is at the epicenter of the chronic underinvestment in supply. As the world is trying to figure out how to transition away from oil, gas, and coal, the world has realized that doing so is incredibly difficult because demand is still robust. But supply has been decreasing at an alarming rate, so much so that the supply-demand imbalances that we see today could see oil, gas, and coal prices substantially above where they currently trade. We have harnessed a number of opportunities within the energy sector. Finally, I'll talk about the shipping sector. This is another story that takes us back to the GFC. Leading up to the GFC, there was an absolute glut of ships being built. Too many ships for too little routes. But post the crash, we saw demand falling and hence new ships had stopped being ordered. So order books were at their all-time lows. We started building a position in shipping well before the onset of COVID-19. And whilst we couldn't predict COVID-19, we couldn't predict Russia invading Ukraine, and we couldn't predict Houthis attacking ships in the Red Sea, what we did know was that with the chronic undersupply in ships, any shock to demand would bode well for future prices. And that had to clear through higher shipping rates, which ultimately falls down to profits, which ultimately falls down to return to shareholders. So we were able to harness a number of opportunities in the shipping sector for our clients.
Mikhail, it's been great chatting to you today. Thank you so much for joining me.
Thanks, Audrey.